Hello, I'm Greg Bell. Welcome to TD Active Trader Live, brought to you by TD Direct Investing. This is your educational one-stop shop for in-depth market analysis, investment insights to help boost your trading potential. Coming up, gold prices hovering at new fresh highs. Investors reassessing inflation and global risk, plus Walmart is set to join the Nasdaq 100 later this month. That's a major milestone that could drive fresh index-linked demand for the stock. We're going to take a deeper dive into that in today's technical take. And our trader debaters, they are standing by. They want to give you the bull and bear case for BlackRock. Can the world's largest asset manager keep growing assets in a volatile market? Or are margins and regulation becoming a bigger concern? That's all ahead. Don't forget to like and subscribe. You're watching TD Active Trader Live. You're half an hour to the trading day. Let's check on the S&P 500. Struggling a bit for direction. We did have core inflation in the States coming in lighter than expected. That gets your hopes up about the Fed perhaps being a little more aggressive with rate cuts this year. But we also have a lot of corporate earnings coming in. So a bit of a push and pull right now. The S&P 500 has slid modestly into negative territory. Let's jump into the heat map. Maybe it starts to tell the story of the push and pull and what's going on here. You can see NVIDIA's not giving us much today, but AMD and Intel are making nice gains alongside Google. But you have a lot of red on the screen, and particularly here in the financial services as we kick off bank earnings season. I think we want to jump into Delta Airlines right now. Got the airline falling more than 5% in the early going, but now it's staging a bit of a comeback. And this is a mixed story as well. Mixed results for their most latest quarter, a modest beat on the bottom line, missing on revenue. I saw that they have some pretty bullish projections for this year, so investors still trying to slog their way through that one. JP Morgan, I noticed it on the heat map in the pre-market. I was trying to decide which way is this one going to go. It has decided to go lower in the first half hour of trading, topping earnings and revenue expectations for the fourth quarter. So notch that in the positive column. Company did record a one-time pre-announced charge related to its takeover of the Apple credit card loan portfolio. So that might be weighing a bit. And then if you dig into the details, trading revenue beat Wall Street estimates, but investment banking appears to have disappointed. So as investors sift through that as well, and perhaps some unfavorable credit card policies coming out of the Trump administration. I think it's all just playing a role, isn't it? And that's your market update. Joining us now for a more technical take on what's happening out there in the markets, here in Amin and Jason Nanick from our TD Direct Investing Education team. We got a lot to talk about. They're all bangers. Let's start with gold.
Yeah, let's start with gold, Greg. The yellow metal, again, precious metals are jumping to records. It's not just isolated to the yellow metal. Silver's doing the same thing. We've seen the US dollar dropping, of course, which is a bit of a tailwind for this metals to go up in price, and then stocks are whipsawing. So that's the theme so far this week. Gold we saw as of yesterday, and I'm going to have to correct myself because it's hit a new record high today at 4640, but 4600 was kind of the high that it took out previously just before the turn of the new year. And this is really due to the fact that we've got safe haven flow demand that's coming up, also in the fact that we had some news that broke over the weekend about the DOJ putting the Fed on their crosshairs now, and that's really put into question the independence the Fed is going to have as more as anything. So you have this combination, you have rising political pressures and geopolitical, what's happening across the ocean in Iran, Venezuela as well. So that's kind of a mix as well. So, the question is, does gold still have legs to keep running? And as long as these persistent, political tensions are playing at play, I believe we still have some room to run over here. The other thing I also wanted to mention was China is also still continuing buying. So I looked at the numbers. They have, for the 14th consecutive month, they've added to their gold reserves, which now currently stands at about 319.45 billion at the end of December that they have. And then when you think about the volatility picture as well, we should expect volatility to dominate in the near term, but it quite hasn't done that recently. And that's maybe that the market's just kind of shrugging this news off and it's not really being meaningful. But looking at the charts, let's actually pull up and see how this price action is. I'm going to talk about something that's known as break of structure in technical world. And break of structure essentially tells us whenever you have a swing high, it needs to take out that previous level for a new structure to form. And you can see back in October, Gold had hit this 4,400, which was the rally at the high. It pulled off of that. We did form this telltale double bottom, which is a bullish reversal pattern that formed, and it put another leg up. But going into the new year, we saw this big bearish candle, and this is profit taking essentially. That's what it was. Just at the turn of the new year, so silver and gold had a bit of a pullback. But now you have a new break of structure, Greg. And what this is this previous high, which was around that 4,500, was taken out. I marked this as a resistance, this 4,600 level previously, because it just broke that on Monday, which is what caused the new high. And today, we're actually sitting, this is what you want to see in technicals. You want to see a retest of that level to confirm if it's going to be a valid support level. I haven't made it a support just yet. I want to see another confirmation of it sitting there. But we're squarely moving in the direction and still forming this upward trend, still respecting that. So as long as this holds in place, we're still forming this bullish trend overall with a lot of strength going into this next few weeks here.
All right, good chart there because a lot of eyes on gold and where it could head next. But of course, we've been talking about the financials. Not only do we have the kickoff of bank earnings, but we have some interesting rumblings about credit cards, too.
Yeah, there's a little bit of ruffling some feathers in the banking sector, of course. I think the big news is we've got the Q4 earnings parade starting this week with the banks, obviously. The big banks will be coming out earnings tomorrow there. But the big news is that's also rattled the markets a bit and has caused a bit of a pullback is the credit card interest rate cap that's being proposed at 10% for 1 year. This is really, President Trump announced this in order to address voter concern about the high cost of living. Now, obviously, card issuers are going to take some issue with this, especially those who are going to be more exposed to it. So companies like Capital One Financial, who caters to more of a wider spectrum of credit profiles, and then Synchrony Financial in the U.S., which really does a lot of the store credit cards in place. Some of these run north of 30% interest rates, 35% in some cases there. You had other issuers also pull back on this news. So JP Morgan, Citi also have a large credit profile as well as American Express, maybe not to the same degree as the other ones there. But the industry it doesn't have an appetite for it. I think what it means if this does even happen is you would have a lot of folks with lower incomes and lower credit scores. They'll probably lose access to credit if this even came to pass.
We're not going to issue you a card.
You're not going to issue you a credit card.
Yeah. Not gonna do it.
The other side of it is how do you make up for that revenue? And that means either adding new fees or hiking existing fees that would come in place. And overall, that's just bad for the economy. If you don't have these people spending the money, then what does that mean for the economy? So there probably might be some middle ground, but at this point, it might not even make it to the Congress, cutting room floor. There's no executive powers we'll just put in place. But let's look at the chart because I do want to look at an index that really covers the wide spectrum of financials that we have. And this is the KBW Nasdaq Bank Index that we have, ticker symbol is BKX. And we can see it's been forming this sort of long trend, uptrend. We had this classic bullish flag pattern that had formed. Now it's been hovering and kind of darting between the 21-day and 50-day moving average, which is in this yellow and blue line here. But right now, just as of the end of November, it started this new bullish channel that it's formed in. You can see today it's actually just retesting the lower bound of it and just sitting above its 21-day moving average at the 166 level. The 170 is still a resistance level. I mean, we'll probably have earnings that will be another catalyst, possibly a tailwind, possibly a headwind. So coming out of this week, we could see if it pushes up higher and over that 170, and that'll start another leg up there.
Interesting stuff there. You have a company that we don't think of as a tech company that's going to start hanging out with tech companies.
Yeah, they're starting to kind of reclassify what their image is, I guess. But yeah, you mentioned it kind of off the top of the show. But Walmart is leaving the NYC. It's been listed there for over 5 decades, and now in the last number of weeks they've joined the Nasdaq. And actually, starting next Tuesday, they're going to be part of the Nasdaq 100, replacing British drug manufacturer AstraZeneca. So that could lead to some rebalancing in some ETFs, some mutual funds, and portfolios and things like that. But we hear about this from time to time. Companies do change kind of their listing alignments, and that's to better kind of align their investor base with the other companies that are around them. Some of the major reasons we've seen in 2025 people leaving the NYC is to kind of get away from that financial heavy kind of weighting of the NYC, and then kind of better aligns them with other competitors and brings them in with some of the other bigger value companies out there. We're talking the Nvidias and the Apples are on the Nasdaq versus the NYSE. And with that kind of technology focus in mind, Walmart has actually just this past Sunday announced a partnership with Google, talking about kind of stringing together Google Gemini and their AI, kind of their chatbot agents, and trying to make it so that it's possible for Walmart customers to buy directly right in the chatbot without leaving. And they're able to use a number of different currencies and payment methods. So they're really kind of making a play to kind of meet their customers where they are. And this actually reminds me of from a quote from a gentleman you guys all chatted with a few weeks back on the Thursday edition of TD Active Trader Live. It's from Ed Yardani. He was talking about how all companies are kind of see themselves as AI companies, either in the business of kind of producing the AI, or you're figuring out how to better use it for your companies. And Walmart seems to be kind of trying to kind of really bridge that gap for themselves. And Walmart CEO has come out and said that kind of this partnership and this focus on AI is going to be really the next great kind of evolution in retail. But let's take a look at Walmart's chart to see how they're going. They've clearly been on an uptrend over the course of 2025. Walmart outpaced the S&P 500 quite substantially here. They pulled off 23% kind of pricing increase versus the S&P's 16%. So one of the key price levels that was kind of noticing for me here is that kind of 104 level is where it previously was acting as resistance. It's broken through and kind of confirmed that breakthrough on a couple of different occasions. But as we kind of move into kind of more recent price patterns, noticing here there's been a significantly sharp increase. It's kind of formed a bullish flag pattern as we've kind of crested into the new year. Over the last 2 days, we've actually confirmed a breakout above that, which is actually set kind of new kind of all-time highs for Walmart. So with this bullish flag pattern, if it does continue, we don't see a retest back towards the flag, then oftentimes we'll see a kind of sharp increase, very similar to the increase into the pattern. So time will tell, but interesting stories, interesting news. Walmart's kind of making waves. So
interesting stuff there from both of you guys. Thanks for that. If you have a question for us from home, here's how you can get in touch with us. Just email td.activetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. It's going to take you to our TD Active Trader Live website where you can try out the platform risk-free. You open a practice account, you click on Try TD Active Trader, that button right there. Then when you're ready to switch to a live account, simply export your workspace and start trading for real. It is time now for the main event, Trading Debating. This week, the stock in the spotlight is BlackRock, the world's biggest asset manager, invests on behalf of governments and institutions and everyday people like us. Now, before we get going with our debate, just a reminder to our viewers that the securities and strategies discussed on our show are for educational purposes only, should not be considered investment advice or buy, sell, or hold recommendations. Options trading carries high risk, may not suit all investors. Significant losses are possible, so it's important to assess your own risk tolerance. Make sure you do your own due diligence before engaging in trading. Now back to the stock of the hour, BlackRock, which made you guys want to pick this one to debate. It's a big one.
Sure it is a big one, Greg. I think that's probably one of the stories we probably want to start with. Also, I think if you look at the investment landscape and the industry itself, it's going through a bit of it's actually on the tail end of going through a shift where you've seen a lot of Gen Zers getting into the space of investing, but you've also seen a meaningful shift from mutual funds into ETFs, and this is one of the biggest ETF player. In fact, not by timeline, because Vanguard would have been there earlier, but Larry Fink, who started BlackRock, has far surpassed like what you would think Vanguard would do. So it's worth looking into their books and seeing how they're performing there.
All right, what intrigues you here?
Yeah, it's kind of the same story. The size, the scale, the scope of the AUM for BlackRock, and it's it's time we debated the king of the asset managers. Biggest AUM, 13.4 billion, or trillion, I should say. Let's use a T in this one, and it's up from the previous year by 2 trillion. So yeah, it's definitely worth the conversation.
All right, I got the bell right here. We got the clock over there to keep you guys honest. We're gonna get some time on that clock. You get your 2.5 minutes each to make your cases, the bear and the bull, and then you get your time to counter. And as always, you draw from a hat. Jason's got the bear.
I got the bear here. You're right. So, all right. So BlackRock is not just a market leader. I like to also frame this as actually market dependent. So they're low pricing offerings, but they come with high fixed costs. So those are difficult. Those things they need to wrap their heads around and continue to work. So if markets don't continue to rally and continue to push strongly forward, earnings growth could struggle, and it really might make it difficult to justify those kind of premium, those enhanced kind of valuations that the stock price is demonstrating right now. But a few of the things that I think that could really kind of stand in their way as headwinds is around fee pressures, and how that structurally can hurt their profits. BlackRock makes most of its money from management fees, and that's something that's under attack. Over 60% of BlackRock's AUM is in their iShares ETFs, which have very low fees. So that's not a bad thing for customers like us. But when we're trying to, and you're making your money off these low fees, and we're thinking about these fees have gone down by at least 30% over the last decade. That makes it hard to replicate that money coming in the door. Even as assets grow, revenues don't grow as fast. They need to have huge asset growth just to keep revenue kind of running and churning at that same pace. And then second of all, their market risk is is revenues tied to asset prices. So if we get any sort of pullback in the market, that could really fundamentally change what they're making. If global markets fall by 10%, their asset under management is going to drop by $1 trillion, and it's going to wipe out about $400 to $500 million of revenue, just if one single client leaves, or if those assets do pull back. So we're not talking small change here. But let's get ourselves into the chart and take a look here. So prices. If we're looking at a longer time frame, BlackRock has certainly seen increase in the prices, but over 2025, we can see there's been a bit more of a meandering, and we can see prices kind of consolidating and trying the top and not continue to push forward with greater momentum. 1120, we can see this up in the red line. That's kind of what I've kind of deemed a bit of an inflection point. The stock rallied certainly up to that earlier in the year, but has really shown hesitancy to kind of push beyond that. When they hit all-time highs, kind of previous around their last earnings season, there was significant selling off that's coming off that price. We have what we call a doji star, which is a really indecisive candle at the top, and followed by successive, very large body red candles showing that there's been significant market pressure selling off, and there's been continued selling off up until very recently. Now we've started to kind of bounce off lower prices, but there's been a head and shoulders pattern that's beginning to form that could mean that lower prices might be on the horizon.
Okay, there's the bear case. What would a bull say about BlackRock potentially?
Yeah, I'm gonna start by saying, the way I think of BlackRock.
Your neck there.
Yeah, just
You're limbering.
getting ready to go there. BlackRock is basically the equivalent of asset management of a central bank with a ticker. It's being priced like it's a nice to have fee stream rather than a toll booth on global capital flows, digital assets, and retirement savings growth. Now, its profitability, which is what I'm going to focus on, is driven by a unique flywheel model that really focuses on its massive asset scale that it has, its high margin technology, and its strategic expansion into private markets. So let's talk about the scale first, because we mentioned at the top, it is the largest asset manager, roughly overseeing about 13.5 trillion in AUM. This has grown 17% year over year. It is double the closest, not the closest, I think Vanguard is the next closest competitor, but State Street Capital, as they have 5.4 trillion. So you can just, you can appreciate the scale of their enormity. They also have 8 to 10% organic base fee growth on a trailing 12-month basis. So they're making, you mentioned they have low fees, but they're growing those fees and making money on them. What I also wanted to focus on was the ETF leadership on the iShares, which is kind of the core of the foundation of all of this. It is one of the most successful ETF franchises globally, especially in the core equity and fixed income exposures, which account for roughly about 30% of the 17.7 trillion global ETF market. So that's a 30% market share we're talking about the world. And then when you talk about their leadership innovation, that's another thing I wanted to focus on. Was this is the moat that they have on network effects. One is on US spot Bitcoin ETF market. They were the first to the market with that, or one of the first, and they currently hold about a 57 to 58% share, roughly about 85 to 100 billion. Now, why this matters is because these products demand higher MERs on their fees, so they're making more money on the top line. Roughly generates about 245 million for them. But then the technology, they have this platform called the Aladdin platform, which is a risk or portfolio management analytics platform, which is licensed and subscribed to other financial institutions, which is generating recurring revenue for them. And it's very sticky because it's highly profitable, and companies don't really, there's high switching costs coming out of there. Now, I just want to go on the chart. I want to focus on the weekly chart that I have over here. And I've got this ascending channel pattern that I want to form, which I think is going to show a very compelling bull case story. You can see bouncing right off of this lower bound area and just sitting on this support. And every time it's tagged this upper range, when it's come into this area, there is still room for it to run into that higher end at the 1080.
Squeezed it into 14 seconds. I didn't know if you're going to pull it off.
I was
Running
getting
away
nervous
with
for
the
him a little bit, but
Yeah.
That was
Not
like the
that
sporting
nervous.
part of the thing for me. I was like, can he do this for 14 seconds? But you have 3 minutes
Look at
now. 3 minutes now to counter each other. You can go into the platform as much as you want, pull your charts back up, and just go for it.
All right, so we're talking about kind of fees and things like that. Now, one thing when we if we can equate it to other businesses, talking about margins, operating margins, they've seen, if we're comparing quarter over quarter from over the last 5 quarters, we've actually seen declines in operating margins. So that's bringing concerns around, further speaking to enhancing profitability. Net incomes have also been negative 2 of the last 3 quarters. We're talking in fiscal 2025, 19% and 4% declines in quarter over quarter. And then if we're thinking about kind of what investors are thinking and what analysts are thinking going forward, I'm talking about price to earnings, PE right now, 28 PE. That's well above near the top end of the investment services. And then analysts are thinking about that might be overvalued. Thinking going forward-looking PEs down 20 is only around 22. So we've got less faith in out there in the market of where they're at right now.
Jay, but when you're talking about PE, in the industry itself, but you got to look at the capital markets industry specifically, who they compete with. They're actually sitting at about 25 on average. So yes, a little bit of a premium, but why would you not pay a premium for the top dog in the house? And then second, you've got their peer group average. If you look at just the peers alone, Vanguard, State Street Capital, Invesco, those PEs sit near the 48 range. So meaningfully high, almost double that you have. The other thing I wanted to also mention was, yes, you make valid points on the compressions that they might have had, but if you look at the last consecutive quarters, they've had double-digit growth for the same quarter in the previous year for the last 5 straight quarters when you're talking about on a scaling of revenue. Also, revenue's grown roughly about 25% year over year to $6.5 billion on the bottom line there. And operating profit is also climbing to around 23% to $2.6 billion is what they have on that last quarter that you've got to keep in mind there.
You know what featherhead and cap they've lost though? It's very much like the debate we had around Modelo and Michelob last week. They're the biggest ETF in terms of AUM is no longer the IVV at BlackRock. It's now moved over to Vanguard, so they've lost that kind of coveted title of large ETF. So there, but I do want to quickly jump to the charts just to kind of show the inconsistency the market's been showing. What I've got here on is a 30-day chart. Every time we've seen a rally that's appeared, there's been distinct negative pressures. 2 times when the rally's peaked, there's been a 3 black crow formation that's popped up, showing the market's not willing to go. Whether or not they're profit-taking or not, the market is not allowing the price to continue to run and move. We've seen quick depressions and depreciations in the prices kind of in near time.
Yeah, so well, I'm going to show a different story over here. So I've actually looked up the Fibonacci levels. So looking at any time you have pullbacks in the price, you want to hit key meaningful levels when we're going to see sort of retracements back to those levels. And right now where it's sitting, just where I've marked it over here, which is just sitting at above the 1,075 support area. This is marking the 61.8 Fibonacci level, which is the golden level right over here. And if we have a move up, and if we can do it back to the top, where we're capturing back at least, back to the 1100 mark over there that you're going to see there.
All right, I love the way you guys battle. It was the battle of the charts early there in that counter.
Yeah, we had to get in the charts there a little bit.
We've had the debate. We've had the counter. I think it's time to jump into the platform, look at some possible option strategies. Jay, you kick things off with the bear side of things. How could a bear play this?
Yeah, let's do this up. So what I'm thinking about is kind of observing kind of last quarter's earnings and thinking about how the stock reacted to that. There was quite a significant pullback, over $200 in terms of just specific price depreciation. So if we're thinking about trying to find an opportunity to predict that same level of sell-off, kind of but with a fairly inexpensive price, there could be an opportunity to do a bear put spread. So in this particular case, we'd be buying a closer to the money, but still out of the money put, and then selling something a little bit further out of the money to bring in a little bit of premium to kind of help offset the cost. So kind of what we've got on the screen here right now, I've marked out a few different things. I've marked the expected move on the chart, which is the gold lines that are showing here. It's about plus or minus $64 off of the current price. I've got that just by pricing in the at-the-money straddle from the option chain on the expiration date we've chosen. So we've chosen a little bit longer time to give kind of time for the trade to work out to the end of the month, out to January 30th, so out past past the earnings date. But we can see here on the chart there was a significant decline off highs of over $1,200. We had over $200 of decline. In this particular case, if we move my chart over to the right, if we get the same element of decline in place, yes, it is outside of what the market's predicting, but if we get a bigger outsized move, this is where this low-cost trade could potentially benefit you. You're buying the $1,000 put strikes and then selling the 900s. We had a very wide spread of $100, meaning there's lots of meat on the bone if we do get that outside move to really take advantage of this. So we're getting this. When I priced it in last night, it was around $630, a little slightly more expensive this morning. So when we're thinking about break even, that means that's the price at which our trade becomes profitable at expiration. If the price drops below, it's only $993.70. So we're getting into this at a very low credit or very low debit, mind you, but we've got lots of potential profits. So the potential profit we can make in this is the differences between the strike prices at the 1,000 and the 900, less the debit we paid. So we've got quite a bit of potential profit to make here on the trade if we get that move.
What if it all goes against you?
Yeah, this is directionally focused, right? So it does need to go down for us to be profitable. The nice thing about debit spreads here is that your loss is going to be limited to what you paid going into the trade. So it's just that 630 as what the natural was when I did the trade. So $630 per contract with that big high potential for profit.
All right, here, and how could a bull possibly play this?
Yeah, so kind of similar to what Jay was talking about. One of the things I looked at was to first understand a bit of the liquidity profile of a stock like this. Now, BlackRock isn't a very liquid stock when it comes to options, meaning we don't see a lot of volume traded, which means you're going to tend to have wider spreads, especially if you go further out of the money. So one of the trades I wanted to do going into earnings was to do a trade that was going to be directionally biased towards the upside over here. But I also wanted to I wanted to mitigate some of that liquidity or the wider spreads. And so this trade you could potentially do is a long call butterfly spread strategy. So what we're essentially looking to do is, again, it's a directional play to the upside. We're looking to buy the 1,080 strike, which is pretty much sitting at the money. We're going to give ourselves a little bit more time, so we don't want time to erode the value of the contract in case it doesn't go our way. So we're going out to the March cycle over here. We're going to sell the 1020, which is kind of an area where it sort of rejected previously. So just going into caution, the expected move into this earnings print for this week is about a $46 move to the upside or the downside. So that puts us squarely just in our target range if it gets there. But then I further want to reduce my costs as much as I can. And so I'm going to, or I should say, cap my risk because of the double calls that we're selling here, is to buy the 1060. So all in all, we're doing a 40 wide spread across the board on either side of it, which is what forms the wings of this butterfly, so to call. And what happens is this trade, when I priced it last night, obviously it was a bit higher, was $1,000. I think when I pulled it up just now, it's sitting at about close to about $700, but we'll go with 1,000. It's an even number. $10 is what this trade will cost on a single contract. And so that means our break-even price is $10.90. We need at least BlackRock to get to $10.90 to start being profitable, and then we start making a profit on there. But it's almost like a double negative over here, because once you hit the 1020, that's our max profit, Greg. We needed to kind of take a pause at the 1020 when it gets to what we call the body of the trade. But if it goes beyond that, we start losing or eating into our profit if it goes higher. But if it goes above or outside of the wings is what we call it, because I know you're going to ask me, what's the loss?
I know you had it on the screen that was a little hidden around my camera, so I didn't quite see it.
Yeah, so the loss is going to be the spread. What we paid for this trade, it's a debit trade. In this case, it's going to be the $10 that we're going to lose. And that's going to happen when it goes outside of the wings, the price. And that means it's either going to go above 260 on the top end, this should be 1,160. And it's going to go down to below 1080 on the bottom end. And then we'll start losing on this. I didn't cover the profit, but just to clarify, what we take the spread, which is $40 minus what we paid for this trade, which is $10, and that's what we stand to profit, which is the difference of $30 on there.
All right, interesting possible strategies there. Thanks for laying out the bull and the bear cases for BlackRock. Just a reminder to our viewers that this debate was for educational purposes, does not reflect our personal opinions about the stock. Before we move on, Jason, you're going to elaborate on creating custom workspaces.
Yeah, it's one of the really kind of inherent benefits of the platform is that there's no kind of one size fits all. Just because Hiran likes a particular layout or I like a particular layout, it doesn't mean that the audience or whomever's using it needs to do it that way. You can really kind of mold the platform to be kind of whatever you like, whether or not that's on your screen here or if you've got kind of array of monitors at home, you can expand the platform so that you're really taking advantage of all of the real estate. But I kind of wanted to show everybody how easy it is to kind of manipulate that and create your own workspace. So jumping back into the platform, and noticing here we've got all our different tabs for all of the different kind of tools we have. But if we wanted to start creating our own workspace, the little plus button kind of towards the end is where you do that. And we got a workspace 1. You can rename that to be whatever you like. But we now have this blank canvas that's available for us on our screen. These drop-down menus at the top of the page, these are where you'll be able to find all of the different components that the platform offers that you can kind of craft into your masterpiece. All right, so let's kind of draw out here. This is kind of like a kind of standard kind of option layout that I've created for myself in the past. Most things are going to be found under the trading tab. So for instance, if we go click on trading, we can see I'm going to go and drag out a watch list and I'm going to drag it onto the screen, and now our watch lists are available. And if we can go ahead and change that watch list to maybe something that we've used in the past. So now we've got a bunch of different stocks that are going to be available there. Now, if we want to go start adding in other features, going back to our drop-down menus, for instance, I want to put a chart on here. So if I go, you can go ahead and click chart. The system will put it where it wants. I like to have a little bit more control, so that's why I like to drag it out. And with the highlighted areas where I'll be able to drop it, and so it's going to be available for me to view from there. The last thing I want to put on here is, let's actually minimize the, shrink down the option chain a little bit, so we've got a little bit more room for everything else, is I want to go ahead and put an option chain. Go ahead and back to trading. Option chain, we can drag that out and put that exactly where I want it. So now we've got a watch list, a chart, and an option chain, but now we need to get them working together. We can do that by looking at the linking function, this little link widget that's at the top of every component. By clicking here and putting them on the same color, that means that anything that I put in these in our, like if I choose a particular symbol from a watch list, it's going to load the chart and it's going to load the option chain. So now we're minimizing clicks. We're being able to quickly access fundamental information and then get to trading right from the option chain itself. Now, just to kind of help the audience a little further, I did go through that quite quickly. We do have videos on our education tab, but if you're looking for a kind of a more hands-on approach that's guided through an instructor, we teach classes. We call them master classes every Wednesday at 2 o'clock, dedicated to active trader. We've got one coming up all around getting started, customizing, placing trades, managing positions. If you want to join in for that, Michael's running that class Wednesday at 2 o'clock. You're in great hands with him, so I'd recommend the viewers come check that out.
All right, and I love the linking. I'm all about the linking across our different platforms. Then when they start speaking to each other, it's like, this is pretty cool.
Absolutely.
If you have a question about the TD Active Trader platform, or if there's a stock you want to see our debaters go head-to-head on, send us an email at td.activetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. And if you scroll down, you're going to see a tab that says Join that live masterclass. As Jay was saying, this Wednesday at 2 p.m., Michael Zagorski is hosting that interactive session about the platform, TD Active Trader. You're going to explore all those main features that are on offer there. Registration's open now. Check it out. Before we wrap up the program, of course, there's always things on the horizon. What is on the radar? What do you got there, Kieran?
Yeah, I mean, we've this was a funny week because this is almost like the cart came before the horse this week when you had CPI come before PPI, which is usually inversed. So one, we had the CPI numbers come out already today. We know that just sort of mild. I mean, they didn't blow out expectations. So PPI does come out tomorrow, the Producer Price Index. Now remember, this is the gauge of costs of the wholesale level on the U.S. economy for goods and services. And one of the things I think the Fed will also not only look at the headline numbers, but the underlying drivers as well. And the services sector in particular, which drives about some 80% of the GDP, will be key there to look at. So just a confirmation of validating whether these numbers are in fact in line with what CPI printed today. But the other thing that's also going to be big in this news, which we didn't have a decision come last week, but this week potentially, is SCOTUS. And I had to look up what SCOTUS is. That's the Supreme Court of the United States, of course, will be ruling on the legality of the Liberation Day tariffs. And that would be a landmark test for presidential powers, of course. They have a ruling set for tomorrow, in fact. We don't know if they're going to do it. They kicked the can down the road last week. But the key decision will be whether the administration can use provisions under the International Emergency Economic Powers Act to levy these tariffs. And if it isn't, if the U.S. will have to then reimburse those back to the importers to pay those duties. And then, of course, finally, we've got the Beige Book released, the first of 8 for this year. So this is just going to gather anecdotal information on the economic conditions that from the central bankers that we have.
We should have a show where we talk all in acronyms. Like SCOTUS could be ruling on IEPA.
Yeah.
And POTUS might, might not like it.
Yeah, POTUS might not like it.
But FLOTUS, though, I don't know.
I know, we should do a whole full show. We have enough of those to go around. And then finally, it's TSM that I've got in my radar. They're going to be coming out with earnings tomorrow after the market close. So TSM, of course, is the world's largest foundry, 70% of market share. They're going to be reporting the Q4 earnings for 2025 after the bell. And this is going to be a key one for investors to watch on AI chip demand and guidance tied to NVIDIA. This is almost like a preclusion of what NVIDIA might say. And the other key customers, which is also Apple, which contracts their chips out to them as well. Expectation into this earnings print is going to be about 285 on the EPS, which marks a 30% year over year, and revenue of 32.74 billion, which is about a 22% year over year increase. And investors are going to look, as I mentioned, for the 2026 outlook. The guidance is going to be key. What is the spending looking like on the data center and AI chip demand as well? But they're also doing quite a bit of CapEx spending. You know, they've decided to put a few fabs up in the U.S. In Arizona, they've already got some up and running. But New York Times reported last night that they're potentially investing an additional 165 billion to build 5 more chip factories in Arizona, semiconductor facilities. So we might hear some more on that news. But let's look at the chart and see how that's going to shake out in terms of what the price is going to look like moving. So we've seen it obviously remain in a strong bullish channel so far. It's actually broken above this key 308 level that I'm going to point out. It resisted quite a few times. It's been a valid test. So this break is quite significant when it did break at the start of this year. We've seen a little bit of a pullback. It's forming new. We're in price discovery. Anytime you create new highs, you go into price discovery. 335 is kind of the line in the sand now on the top side of it. So the earnings could be a catalyst to push it back into sort of this regression channel, green zone, if you want to call it that, and retest those highs there. So potential market move on this stock is looking at about 50 to $60 is what the market expectation is on the move and coming to this earnings print. If it fails to meet expectations or they don't give a rosy guidance, then we could see it retest back down to the just breaking below the 308 level, maybe sitting in the 50-day moving average, which is just at the 300 level there going into this earnings print.
Okay, interesting stuff to keep our eyes on. We are, of course, getting into bank earnings season in the States. You got Bank of America on there.
We do got Bank of America coming up here. So, yeah, earnings season is in full swing and financials are taking their kind of traditional lead. So focusing here on Bank of America, they're firmly kind of by market cap in that second slot behind JPM from both domestically as well as globally in terms of the size of the bank here. But taking a look at the kind of on a macro level, share prices continue to be, both on both sides of the border, if you will, for banking industry at near all-time highs, rewarding investors, but setting lofty expectations as we kind of progress through the next few weeks. The market is kind of rallying with a surprisingly resilient economy, as well as industry-friendly regulations coming out of the U.S. government as well. They're key factors that are pushing tailwinds, from the financial sector and the market. Yesterday we obviously had the news that the DOJ was kind of investigating Jerome Powell. The market it reacted negatively right away, but it seemed to kind of shrug it off as it came in. And then now we've got the news about the credit card cap. So these are all going to be things to be listening for as we move forward here. But turning to Bank of America, thinking about what to expect from them over when their earnings come out on Wednesday. Earnings per share are expected up by about 17%.
Wednesday or Thursday? We have Thursday on the TV screen.
Let's go with that. Let's see what we've got on the chart. We've got.
I think it's Wednesday. Your Wednesday. It is.
I check those banners before we go to air. I'm in big trouble.
Moving big trouble. All right, but earnings per share and revenue were up by a big margin, 17% on earnings and revenue up by 8%. Net interest income is going to be something that we'll be keeping a keen eye on as well with the successive cuts from the Fed. But they're still expecting an higher of up to 15.6 billion there. So that's something that they're looking for. But also getting to kind of the more mundane numbers. numbers. Loan portfolio and deposit portfolio growth, those are always going to be key metrics to keep an eye on, and this time is no different. But let's take a second and wrap up with the chart here from Bank of America. Not the fanciest chart that I've ever put here out in the show, but sometimes it's just nice to take a simple look and see what we've got on. We've got a clear trend of Bank of America that's kind of going up. I've got in this red line here. Kind of what I've noticed here recently is that we've got 4 times the stock has touched the 50-day moving average over the last year. We're now approaching that with the moves down over the last couple days. We've now touching the lower end of the band we've been moving in, but that 50-day average is right there. It's the gold one that's right there. So coming into earnings, if we break through that, that's going to be setting us up for potentially new lows that we haven't really seen since World Liberation Day tariffs and the stock started to rise. But time will tell. There's still an opportunity for good news to come out to push us and bounce off that, maybe for a 5th time. But once again, Wednesday will be the day I want to be listening for Bank of America.
All right, interesting stuff. It's a busy, busy world. That's what I take away from this show all the time. And lots of great information about the platform. That is the show for this week. We're back on Thursday at 10 a.m. Eastern. We'll be speaking with Diana Avigdor, head of trading at Barometer Capital. As always, investors should perform their own due diligence before engaging in trading. Thanks for watching, and we'll see you on Thursday.